Welcome to a Cofi with the FinTech Pod. We'll explore the latest trends, innovations, and ideas shaping the financial industry. Join host Alex Irigoyen as he interviews leading experts in the field. Learn from top CFO, tech leaders, investors, and many more. Join us and get inspired. Let's get started.
Perfect. Hi, everybody, and welcome to a new episode of A Coffee With. Today with us we have Rob Tompkins, CFO of Risk Scout. Hi, Rob. Thank you very much for joining the pod today.
Hey, Alex. Thanks. It's great to be here.
Awesome. So a quick intro, Rob, about your background. You started your early career at Price, then you worked 11 years at Silicon Valley Bank, and now you are CFO of Risk Scout. Seems like all your career in finance. Was this something that you already knew from the beginning when you were at school, or how did it happen?
Yeah, I mean, I set out to, to jump into kind of the sort of finance and analytics side of things right after college. I moved out to San Francisco in the 1999 to 2001 sort of the dot-com boom. And, and it was kind of the initial big sort of heyday of startups. And that's really where I kind of fell in love with the idea of working either in or around startups, and set out to do that. So, yeah.
Awesome. So from the early days, how was those years at Silicon Valley, the 2000s? Any different from now?
Yeah, it was really different. I mean, when you think about just how much has happened, I mean, it seemed novel at the time, but it was really basic now. I mean, we've gone through so many huge sea changes in technology and innovation since then. But it was really kind of the start where a lot of the sort of the big businesses now, what we think of sort of big tech, early versions, were really getting their start. So, but it was still fun to see, a lot of companies kind of rise and then some fail. Some companies, it was interesting to see some companies that failed in a spectacular way back then, were reincarnated and have later since become really big companies now, right? Example, Webvan and Instacart, right? So there's a lot of those kind of fun things to see.
Beautiful. And the question, of course, is going to be obvious. You worked 11 years at Silicon Valley Bank, both in Austin and also in the Bay Area. How have you lived these past weeks with all the news? I assume that you have many friends still inside of the bank. How it's been for you?
Yeah, I mean, I think it's definitely been a whirlwind. Everything's happened so fast. I'm sure that it seems like an eternity to the people who are still there, and even to a lot of the alumni, the former SVBers who are that I've spoken to are just kind of all in shock and going through kind of this interesting kind of phase of emotions, right? I think it started as shock, and then it turned to sadness, and then disbelief, frustration, and then I think a lot of people are now shifting into problem-solving mode, which is great. Awesome.
So I don't know, Rob, if you could explain very, very easily for our audience, what did exactly happen? So what was going on in the previous years at Silicon Valley Bank that led to this situation now in a very simple way?
Yeah, sure. I mean, I think to try to simplify as much as possible, during the 2020 venture boom, VCs and startups piled their deposits into SVB. So in 2020, they had about 100 billion in deposits. That was up from 50 billion in 2018. And in 2021, those deposits had increased to about 190 billion. So they had this massive influx of deposits, which is obviously a boon for a bank in most cases. But with a bank like SVB, they couldn't reasonably lend those deposits out fast enough or responsibly enough. So in addition to their normal lending practices, they decided to park a sizable amount of these deposits in long-term government bonds that were at a fixed interest rate of 1.5%. And at the time, it seemed like, better to earn some return than none, right? The problem with it is it was a long-term bond, right? And so when the Fed started increasing interest rates over time in 2021 and so forth to try to stave off inflation, the value of their bond portfolio dropped. And when the value of their bond portfolio dropped, they had this sort of unrealized loss on their balance sheet. Now, normally that's not a problem because the bank normally doesn't have to realize the loss. They could just let the bonds mature. They would eventually get paid back more than they invested, and it wouldn't have been necessarily a home run investment, but it would have been fine, right? It wouldn't have been catastrophic. But anyway, so in parallel to all this, and this is really important because these things were happening kind of concurrently, right? In parallel to all this, startups were burning more than twice the amount of cash that they had burned historically, right? They weren't able to go out and raise new funds. They weren't able to go out and they had grown to the size that they were just burning cash like crazy, right? And so I think that's really where they create kind of this perfect storm where as the deposits started to drop, as the cash balances started to drop at the bank, the SVB eventually found itself in an unfortunate position of having to liquidate their bond position, realizing the loss, and trying to shore up the delta with capital from the private markets, from General Atlantic and the like. And I think once that happened in a hyper-connected ecosystem like SVB's in rapid succession, that's what created the catastrophic run.
Yeah, no, that's a great explanation, Rob. Like my question, what comes to my mind is like, is this something that no one saw it coming, or how it's possible, right? One of the largest banks in the country, like from one day to the other one, just like it doesn't work anymore. Like, is this not something that people see coming, or regulators?
Well, I think there's a lot more that's going to come out about this. Probably there's going to be books and maybe even movies made about it. I think, what we're finding out is that, the bank was just at the point where it did not have the kind of necessarily the oversight that it probably should have for a bank that had grown as fast as it did. Somebody might say that's debatable, but I think now in hindsight, it looks like they could have used a bit more oversight. I read an article the other day that said even the Bank of England had warned the Fed, the U.S. Fed, that of issues at SVB, and SVB, was without a chief risk officer for a large part of the time during this window, and so there's a lot I think that can be sort of attributed to. What could have been done better. I think there's a lot of people who would say a lot could have been done better in this sense. Both on the risk management side and then perhaps also on the treasury management side. Could they have hedged their bond portfolio or other things like that? So I don't know. I think that it's going to be interesting to see how how and who goes into this in depth to try to get the true full story.
Yeah,
but I'm sure we'll be hearing about it for a while.
Yeah. And how do you see, Rob, the future of the bank? We saw that there are already some interventions in there. How do you think it's going to be particularly for SVB?
Well, the good news is that First Citizens Bank out of Raleigh, North Carolina, announced late last week that they were going to pick up the bulk of SVB's legacy business, and that it sounds like they're going to, it's a little bit early to tell, it sounds like they're going to preserve the brand and have it as SVB, part of, First Citizens Bank, and I think that's good. I think they're going to try to preserve as much for the franchise value and as much of those relationships that have been built by folks inside SVB with everybody else in the sort of the ecosystem. I think they're going to try to preserve that as much as possible because that's really where a lot of the value is, right? And so that's a positive sign. I think there's other parts, of the overall organization that were held at the holding company level, SVB Financial Group, things like SVB Capital and other things. I think what it's going to be, the story is yet to be written, I think, about some of those entities.
Awesome, perfect. And definitely Silicon Valley Bank, it's a bank very related with entrepreneurship. They were doing a lot of debt for startups, right? They were helping a lot in the ecosystem. Do you think this is going to change looking into the future? How do you see the banking industry, let's say, related with the startup ecosystem, right? Because we talk a lot about the bank or the bank industry lately in general in the news, but doesn't seem right that anyone is worrying as much for the startup ecosystem. How do you see that?
Well, yeah, I think SVB carved out a part of the world that and really innovated within that space to try to deliver some of the best products tailored for startups, venture firms, and PE firms that they could come up with, right? And I think that I think it takes a special type of organization and a culture and everything to take advantage of all of that and to deploy it in a responsible way. And I think that if you look at the sort of the fallout of this, right? I think that you'll have lots of other banks out there, whether it's First Republic Bank, Comerica, other banks that are trying to themselves say, hey, look, we're different from SVB. We don't have those same risks. We're in business. We're strong, and so forth. Try to stem, stop the contagion almost, right? But when you look out of that handful of companies, of banks, you don't see a ton of what I would call sort of traditional, and certainly not like very large banks doing things like venture debt, right?
Yeah.
And I think that's a really key piece of non-dilutive financing for startups, and it's something that comes in really handy. When you raise your Series A, and you can borrow, money, and you do it responsibly. It's well underwritten, as most of the loans at SVB were. Then you've got a really interesting business. But if startups can't access that capital, then they're in a bad spot. And I think that's going to be interesting to see who jumps into this space, who fills that void. Will they do it in a way that's interesting to startups, right? Is it economical, and that kind of thing. So, I think that's going to be one of the big things. I think there's going to be there's a lot of other things happening, I think, in the banking industry, like you alluded to, that are maybe even almost more disconcerting than even what we saw with SVB.
Yeah. So how do you see the future of banking industry as a whole? Because now we see that in Europe also already with Swiss having some problems, right? How do you see the landscape for the future? Yeah,
I mean, I think there's a lot to be concerned about. I think there's, I think that we saw as you mentioned, in Europe, we saw the UBS acquisition of Credit Suisse. I think people are kind of really focused now on Deutsche Bank, and are they going to be able to sort of get Deutsche Bank on a better footing? Are there, and where are the next sort of problem banks? That are out there on the global stage. I think there's, in the U.S., there's a lot of people who are saying, well, look, let's look outside of Silicon Valley and start focusing on banks that have really heavy real estate portfolios. Those are long-term assets for banks, but they're at very low interest rates, historically very, very low interest rates. So if you squint hard enough, it looks a little bit like the SVB situation with a lot of banks having a lot of unrealized losses that they're hoping they don't have to realize. And so it's going to be interesting to see if we're able to, kind of hold that kind of at bay. I think the doomsday scenario there is something like the S&L crisis that we had in the 80s, where it was just a really bad situation for everybody, and made that recession harder than it even needed to be, probably.
Awesome. This is great. Thank you very much, Rob, for this masterclass in banking. I think it's been very, very helpful. I would like to focus now more in the entrepreneur side. You are the CFO of Risk Scout. Of course, you have worked in banking industry now as a CFO in tech startup. So for these founders, these finance directors, CFOs in some other startups, how do you see they have to face the future? Because of course interest rates are high, the demand is going down. Venture funding also has gone down, right? So what are the things that you would suggest to other entrepreneurs and other finance leaders in the tech or startup ecosystem to focus for the coming months and maybe even years?
Yeah, I mean, I think a lot depends on where companies are in their own sort of fundraising journey. I think that folks who are fortunate to have raised fairly recently should still be, in my opinion, very, very budget conscious. I think it would be good to try to conserve cash as much as possible. Being hyper strategic about everything from hiring to marketing activities to all of that stuff, right? I think it's important to really kind of batten down the hatches a little bit and brace for everything to take a little bit longer, right? I mean, I think, we may be pleasantly surprised, and this is sort of a flash in the pan, and we come out of this, and everybody kind of takes a big sigh of relief or so forth. But I think that it's better to be prepared. And really start to safeguard cash, preserve cash, and stretch it as far as possible. I just think everything will take longer, whether it's everything from opening a new bank account at a money center bank or at another regional. That can take longer. And then I think you've also got like you said, fundraising cycles taking longer, sales cycles potentially at least slowed a little bit during this, while everybody's trying to, kind of assess the new lay of the land. But hopefully we come out on the back end stronger for it.
Yeah, awesome. That's very helpful. And from this situation, 2020, we had the COVID, but it was very, very good year also for a startup, and this in the second part of the year. 2021 was 2022 and 2023. Don't look as good. What are the learnings that other entrepreneurs or finance leaders have to get from this situation, right? Because it seemed like everybody was doing so great during those years, and now it seems like everybody is not doing as great. Are there any learnings that we can get from these past years?
Yeah, I mean, I think it would, in the boom years, it's all growth and top line focused, right? It's how fast can we grow, how can we get our metrics to sort of emphasize that growth, and we're in good shape, right? I think I think now folks are much more focused on the bottom line, right? How efficient am I with my spend? What is my path to profitability? It's really less about just top line growth. I think top line growth is obviously important. It's vital, but I think there's going to be a lot more focus on other health metrics for startups, especially later stage, mid and later stage startups. I mean, those are the ones that are having that raised money at really lofty valuations, a couple of years ago. Yeah. They're now having a harder time raising follow-on rounds. They're trying to avoid having to take a down round, perhaps, right? And then that's causing their cash to cash balances to plummet. So I think it can't hurt to take a good look at the business and think about, where can we be more efficient? Do we have the right resources, or do we have any excess resources? What can we do?
Mm-hmm. And these health metrics, which ones do you think are overall in the market the ones that VCs or in general are tracking the most?
Yeah, I mean, it sort of depends by sector. I mean, we're in the SaaS business, right? So I think folks are going to be looking at gross margins. They're going to be looking at our our expenses. I think they're going to say, look, how much are you, how much are you investing in the business for growth, and is that the right amount of money, right? Should you, are you overspending? Are you overinvesting with very little return in areas like, marketing, right? Can you be more efficient there? So I think there's just there's a host of things that I think VCs are going to be honing in on, which have to do more with profitability or a path to profitability than necessarily just top line growth.
Awesome. You are, Rob, as well a mentor at Techstars. Any message for our listeners, entrepreneurs? We've gone through all the banking crisis or the situation now in tech startups. Any positive message that you have for other founders or for finance leaders in tech companies?
Yeah, I mean, absolutely. I think there are sort of short, near-term things that you can do with your bank, right? Maybe it's a regional bank or a community bank. If it's a larger bank, they'll most likely have a resource like this. But one of the things that we did is we set up a sweep at our primary financial institution, which allows us to essentially move most of our deposits in excess of the 250K off of out of that main account and spreads it out across multiple other accounts. Think of them as sort of shadow accounts at other institutions, so that all of those accounts are held in amounts that are at or below the 250K mark. And so it's a way to essentially achieve 100% insurance, FDIC insurance, without having to necessarily move all of your money out of your regional or community bank into a money center bank or what have you, right? So there's things that you can do to sort of have your cake and eat it too on that front. So I would tap into things like that. Work with your relationship manager at your bank and figure out what tools they have at their disposal to help with that. But we absolutely really feel very strongly that regional and community banks are going to continue to play a huge role in the overall economy. And I think the other thing too is that there's a lot of really impressive new entrants or relatively new entrants. Look at Mercury Bank, Brex. I think there's going to be interesting things happening there on the where they can do a lot for startup entrepreneurs. They know startups really well. They've built a very similar kind of ecosystem or similar relationships in the ecosystem that SVB and FRB and others have. So they could also be a really interesting opportunity too.
Awesome. Much appreciated, Rob, the tips and all the information you shared. Just to finish, we have a question from our last guest, Luis Rietti. He's asking you, Rob, what interesting new trends do you see emerging in your space, in this case, tech and finance in the future?
Yeah, I mean, I think there's so many things happening. I mean, I think that we're, with the emergence of fintechs and the ability for fintechs to become more interconnected, with mainstream banks. I think that's a huge and important thing. I think if we could figure out the sort of how to manage a lot of the sort of the bank-related regulatory and risk-related elements, that's one of the things that we try to do a lot at RiskOut is solve that problem. Then the connection, the nexus between fintechs and banks is going to become stronger. And I think you're going to see some really interesting new growth opportunities for the overall economy because of it. And I think, when you look at other asset classes, whether it's crypto and that sort of thing, I think you're going to see the kind of the convergence of a lot of these, provided that banks feel that they can do it safely and in a compliant way. So it's really key to see that evolve and to see how all of that plays out, not only just in the U.S. but internationally as well.
Awesome, great, Rob. So thank you very much for all this information you share with us, your experience and all the tips. It's been a pleasure having you today in the pod. Thank you very much, Rob.
Well, thank you, Alex. Appreciate it.
Awesome. Bye bye.
Bye bye.